Hello, everyone. Oh, hard to believe this is going to be the last lecture for the summer session. I hope everybody's doing well. This one will probably be a little bit longer than yesterday's lecture, just because statement of cash flow is just a little more tedious, and so it just takes a little more time. Um, but we should still finish. I would guess in an hour and a half or something like that for those of you that are kind of planning your day. All right. Well, I guess we'll kind of jump into it. We got it's 9:45, so I kind of want to get moving. All right. So statement of cash flows. One thing about this chapter, I think, for most students is if you remember back to usually either intermediate one or sometimes a principles class, statement of cash flows is something that is covered, usually just to varying depths. Sometimes it's done in conjunction with creating the other financial statements, like an income statement, balance sheet, and all that kind of stuff. Um, and so the one thing I like about the statement of cash flows, and we're going to kind of talk more about this in detail, is it really does require that you bring in all the information that you've learned, sort of like with changes and error analysis, where you had to kind of know enough of accounting across a lot of different topics to be able to kind of arrive at the answer. The statement of cash flows is very similar. You have to really understand a lot of different accounts and a lot of different types of accounting and the way things interrelate in order to do one. And so, while I would say, as a practical matter, in most accountants will never prepare a statement of cash flows, or at least not anything like mechanically. Um, the reality is, though, that the skills required to create a statement of cash flows are critical to being an effective accountant. And so that's one reason actually I really like this chapter, and I like having students create a statement of cash flows, because it's really one of the only ways that we can have you tangibly demonstrate the ability to integrate a lot of different topics into one comprehensive problem. And so I like it for that reason. The other thing, as you prepare for this test, so test number 5, there is a statement of cash flows on the test. Now, what I've done on Canvas is I've created a practice statement of cash flows that's essentially just like the test. And so what it does is it uses the lockdown browser and respond to software and all that. And actually there's a spreadsheet built into the question itself. And so you go out to that spreadsheet, you do all the work that you need to do, and then from that you then upload your answer, and then I actually have to hand grade all the statements of cash flow. So it's a little painful for me to grade, but it at least allows you to kind of do one of these statements from start to finish. And it's really hard to do a problem. I've thought about different ways of trying to do it, and honestly I can't figure it out. A way to test you on the statement of cash flows without having a really cumbersome test, and so just be aware of that you will have to do that, but there is a practice version of it, and it's just like the one you're going to do on the test. Now, the other thing I'm going to highlight um, is since this is your actual test is timed, you need to upload your answer before your time is up. So I would do the statement of cash flows first, just because if you're in the middle of doing your statement of cash flows and then the time is up, students you actually won't be able to submit your statement. And students last time had some issues with that. I wasn't aware that it would lock you out. I thought it would sort of automatically upload whatever work you had done. But what you probably would be better off doing is doing work, uploading, and just sort of continuously making that part of your process of uploading that link, or at least saving the link constantly. So anyway, again, just practice that. Hopefully, that will all make sense as you do the practice statement of cash flows. Yes. So Nate, the statement of cash flows is going to be worth 50 points. It's going to be half of the exam grade. Okay, let's kind of jump into this. So why does US GAAP require the separate disclosure of cash flows? One thing you're going to find is that you could really infer. Well, Harry, I don't know if it's the first question, but you can scroll through and get to that question, and then go back and finish the rest of it. So it's not once you go through a question, you can always come back to it. So it's not like it. Although I could reorder it. Maybe I'll just reorder it. That's a good idea, actually, Harry. So why does US GAAP require this? And so what we're going to find is that most of the information on the statement of cash flows can be found by, I would say, combining the income statement and balance sheet together. And so there are some who question why we have this separate disclosure. And in fact, there had been public reporting on these companies from 1933 till I think it was like 1985 or 89. I think it might have been 88 or 89. Before there was a required statement of cash flows. There was over 50 years of financial reporting before they even required a statement of cash flows. And so the information is there, but it still makes the financial statements more useful. But I want to be very clear: useful doesn't necessarily mean just the contents, not just the information, but useful is content. Of course, that's part of it, but also transparency. And so the statement of cash flows is really a transparent disclosure of cash flows, rather than companies, I'd say analysts, people analyzing a company before they had a statement of cash flows. They could sort of infer cash flows from income statements and balance sheets, and this is just a more transparent disclosure of that same information. Another reason why they do think a transparent disclosure is important is because current cash flows are predictive of future cash flows, and in fact, they're more predictive of future cash flows than accruals. And so this is important information, because again, when we talk about useful information, the way that we've defined useful in accounting is that users need to be able to predict the future cash flows of the company. And so given that current cash flows are the most predictive of future cash flows, a transparent disclosure of that information makes the financial statements useful overall. All right, so what information does the statement of cash flows provide? So first of all, users can predict, this is kind of the main point, users can better predict the firm's ability to generate future cash flows. That's kind of the main purpose, is now they're better able to predict future cash flows, and hopefully they can make better decisions with that information. Users can also better predict the company's ability to pay dividends and meet obligations. Obviously, if there's a bond that's coming due, understanding the cash flows of the company is going to allow you to understand what's the probability that they're going to default on that debt. So the statement of cash flows provides better information on that. They also allows users to understand the differences between what's reported as net income and operating cash flows. In other words, they get a sense of what the company is doing in terms of accruals. And so that's important to understand how companies are applying accrual policy, whether they're being aggressive or whether they're being more conservative. It also allows them to get insight into non-cash investing and financing activities, because you're going to see the cash flows related to your investing activities, and so you can see if there are other changes outside of the cash flows, and understand the debt and equity financing of those non-current assets. There are three types of cash flows. Number one, there are operating cash flows, and those are the cash flows generated from the day-to-day activities of the company. Paying employee salaries, receiving customer payments, buying supplies, whatever it might be. Those day-to-day operations. That's the operating section of the statement of cash flows. And then you have the investing section. So this is buying and selling non-current assets. So buying land, selling equipment, whatever that might be. And so again, those are more of those non-current assets that help the company operate into the future. And then finally, your financing cash flows. That's cash raised or spent from issuing or retiring the firm's debt and equity. It also includes dividend payments. Again, you issue stock, you repurchase stock, you issue bonds, you retire bonds, you pay dividends. All these things are financing activities. I want to highlight one thing here, though. Under current US GAAP guidance, interest payments, so interest-related cash flows, those are actually treated as an operating activity. So under US GAAP, interest payments are an operating activity because it's assumed that it's an ongoing day-to-day activity. So I'm not saying it's the correct treatment, but that is the way US GAAP treats it right now. And then just some terminology that you need to get used to. It's not on the midterm, but it is on the final. Just in case you're not used to it, I want to make sure I just highlight these two terms that are commonly used with a statement of cash flows. And that's a cash use versus a cash source. So cash use is a cash outflow, and a cash source is a cash inflow. So if I'm using cash, I am paying cash out. If I have a source of cash, that's cash coming into the company. So just be aware of those two terms. All right, so there are two methods for creating a statement of cash flows, the direct method and the indirect method. The direct method, that goes through sort of what I would call an item by item. It goes through sort of specific aspects of the operating activities, and you report a cash flow related to every single one of those activities. So receipts from customers, payments to suppliers, payments for payments to employees, payments for interest, payments for taxes, whatever it might be. The direct method highlights every single one of those payments individually. The indirect method is more of an aggregate approach to the operating section of the statement of cash flows. And what it does is it basically goes from net income to the operating cash flow, aggregating everything together. And so you do have to see each item and how it's reconciled, but there's only sort of one final operating cash flow that's reported versus having an item or a sort of an activity by activity cash flow. So the direct method provides more detail. The indirect method, I would say, is more efficient. And then under both methods, the financing and investing sections are exactly the same, so there's no difference there. So which one does FASB require? FASB actually requires the indirect method, which is the more efficient method, but they also highly encourage firms to also report cash flows using the direct method. So they actually highly encourage companies to report two statements of cash flows. The first one being the indirect method, but that's required, and the second one being voluntary but highly encouraged, the direct method. As a practical matter, pretty much no companies use the direct method. Almost all of them only report the indirect method, so just be aware of that. All right, so when we have these comprehensive problems, so again, you're going to have one on your test. We're going to do one in class. I think there's a practice problem as well. Lots of practice on this stuff. So I want you to be aware that each statement of cash flows is a unique puzzle that you have to solve. And so it's sort of like if you've ever done like a jigsaw puzzle, each puzzle is unique, but you can develop a skill set that allows you to get more efficient at solving puzzles. And so the reason why some students, I would say, get initially intimidated by the statement of cash flows chapter is because they're like, wow, you're saying, the problem on the test isn't going to be like anything that I've seen before. And you're right, it's not. Now, it's going to use the same skills that you've seen before, but it will be a unique puzzle. And so that's intimidating for students, but I will say most students take the time to make sure they develop the skills, and then they end up doing very well on the statement of cash flows. So hopefully, it just takes time. So it's going to require all of your accounting knowledge. You're going to have to understand how different accounts relate to each other, and you're going to have to also understand how the balance sheet and the income statement are related to each other as well. So there's a lot going on. And so, but it's, again, the way my approach is going to be, since the statement of cash flows is kind of touching on topics that are a mile wide, we're only going to be going a few inches deep on any one of those topics. So it's not going to get overly complicated, but in practice it does, to understand how a statement of cash flows is put together. Many companies have software that do it for you, but obviously somebody had to write that software too. You can't memorize this problem and believe that's sufficient. I hope that's obvious. You need multiple examples and repetition, and of course I give you plenty of opportunities to do that. And again, hopefully we're going to develop a method that's going to minimize your mistakes. Oh, and by the way, on the test, just so you're aware, I would say 65 to 70% of students, maybe even higher than that, I don't know, will go through the statement of cash flows. And at the end of the day, the one way to check your statement of cash flows is to say, okay, when my statement of cash flows says I should have an ending balance in my cash, it's going to give you a number. and then you check that with the balance sheet. 60 to 70% of the time, those two numbers your first time through will not equal out, meaning that you've made a mistake. Now, just as a test-taking approach, if that's you, the 60 to 70% of you that's going to happen to, do not go in and start changing a bunch of things. If you start doing that, you're going to probably create more problems than you're solving. What I typically suggest is that you do the statement of cash flows one time through thoughtfully and as clearly as you can. And if it doesn't equal out, then go back through, after you've completed the rest of the test, go back through and say, okay, can I identify a specific mistake that I made? Did I do a math error? Did I do a plus instead of a minus? Did I forget an account? Did I include an account that I should not have? If you can identify a specific mistake, then obviously correct that mistake. But if you cannot identify a specific mistake, my suggestion is that you leave it alone. And the only reason why I make that suggestion is because I've seen thousands of students do these, and most of the time when students go back and start tinkering, basically like, well, maybe it's this, let me make that change. Well, maybe it's this, I'll make that change. Well, maybe it's this, I'll make that change. The vast majority, the vast majority of them actually end up doing worse. So basically imagine that you forgot an account that you should have included, and you go ahead and say, well, let me change this other account, see if that works. And let's say that for whatever reason, oh, it worked. It all equals out now. I made this random change and it equaled out. Well, the problem is now you have two things that are wrong. And so, if you can't identify the specific mistake, you're more likely going to correct something that was already right. And now you've got two things wrong instead of just one. All right. So, again, there are several skills that you're going to need. You're going to have to understand and be able to process comparative balance sheets, so year-over-year balance sheets. You're going to have to understand income statements, both the sort of what are the accrual components and what are cash components of income statements. You're going to have to understand the implications from individual account transactions. And again, create a consistent and repeatable approach. My approach that I use is I calculate cash flows from operations, then I move to the investing activities, and then finally the financing activities. And so that's the approach that I use, and it's the one we're going to use here today. But again, if there's another approach that you like to do, that's fine, but you need something that's repeatable and consistent. Okay, so we're going to start jumping into a problem. And so on the test, just like this, you'll be given an income statement for 2020 or whatever year it is on the test, I forget, and then the comparative balance sheet, which is 2019, the prior year, and the current year. So you need this information in order to do a statement of cash flows. And so again, notice there's a lot of items here. The test will not have this many items, so this is a more comprehensive than what the test will have, but at the same time, this will give us really good practice. And so we're going to kind of jump into creating a statement of cash flows. Notice the format at the top. You have the company name, you have the statement name, and notice the label on the date is for the year ending. The reason why we say for the year ending is because the statement of cash flows, it is a flow statement, sort of like an income statement is a flow statement. So if we go back to the previous two, notice that the income statement says for the year ending, and the balance sheet says as of. And the reason why is because that, again, this kind of back to principles, but the balance sheet is a point in time, it's a snapshot, whereas the income statement is kind of like that movie, it's over time. And so the statement of cash flows is also over time. It's accumulating cash flows over the year 2020. And so when you format the date, you need to say for the year ending. The date by itself is not sufficient, so you can kind of think of it as a free point just by formatting the date correctly. All right, so the first section on a statement of cash flows is cash flows from operations. You must start with that section. And so we're going to start creating the statement of cash flows. We're using the indirect method, and then we're going to also illustrate the direct method, but we're going to start with the indirect method because that's the one that's required under US GAAP. And so with the indirect method, we start with net income. And so when you have your cash flows from operations, the first thing that you list is net income. And then after you list net income, you have to identify within the income statement non-cash, non-operating items. And so we need to look for non-cash, non-operating items. And when we say operating items, what we mean is those items that deal with operating cash flows. And so if it's not an operating cash flow, we should sort of try to pick that out and try to understand how to handle it. All right, so as an example, depreciation expense, that's a non-cash item, and also, of course, that deals with non-current assets, so it's an investing related activity or item. And so we need to, basically, you back it out. So the idea is I'm going from net income to the operating cash flow. And so I need to make adjustments to my net income account. And the first adjustments I'm going to make is I'm going to take things off the income statement and basically unwind them out of net income. And so depreciation expense, of course, is a decrease to net income. And so to unwind that expense, I need to add it back. And so that's why we're adding back depreciation expense. Similar for amortization expense is a non-cash, non-operating item. And again, to unwind it, we need to add it back. And then we have these gains and losses on sale. And so there's two gains, gain on sale of equipment, gain on sale for the building. Though again, those are additions to net income, so to unwind them, I need to subtract them out. Now, one thing that students sometimes will struggle with is that, well, if I make a sale, doesn't that mean I received cash? Yes, it does. Now remember, the gain measures the difference between the book value of the asset that was sold and the cash that you received. So there's a difference there. So the gain is not the cash flow for sure. We know that. But the second thing is the related cash flow to this sale is an investing activity, not an operating activity. And so this gain or loss, this has nothing to do with our operating activity. So I just need to get that off my books, unwind it out of net income, so that with my cash flows from operations, I'm dealing with only those operating activities. And so again, we add back the gain and we subtract out the gains and add back the loss. And so those are all the items on the income statement that we need to make adjustments for. So now the next adjustments we need to make deal with the balance sheet. Now this is one that there can be a little bit of a mechanical approach, and that's fine, but I want us to be thoughtful about what we're doing here. So when we talk about operating activities, what we're talking about, those day-to-day things that generate cash or use cash, so either sources or uses of cash from our operating activities. And of course, the main sources and uses of cash come from the income statement. I make a sale, I incur costs, all those things. I get that. But there are other sources and uses of cash that actually don't show up on an income statement. As an example, let's say that I'm better able to manage my inventory. Well, that doesn't change the number of items that I'm selling. In other words, I sell 1,000 widgets in a year. It doesn't change the number of things that I could sell. But it may free up cash. In other words, it's a source of cash that doesn't show up on an income statement, because freeing up that cash is a source. Or let's say that I overinvest in inventory. Well, that's a use of my cash that also doesn't show up on an income statement. Now remember, we're going from that income to operating cash flows. And so we have to think about what are the operating items here on a balance sheet that could either be a source or use of cash due to the way that I manage them. And so the way that we walk through this is we look at our current assets and our current liabilities, and we look at the operating current assets and the operating current liabilities, and we say, okay, am I managing this item differently than I had before? And due to the way that I've managed this item, is there been a source of cash or has there been a use of cash in the management of that item? And so we're going to start by thinking about receivables. Now what I do is I combine receivables into a net receivables. I have seen this taught other ways, where you have the gross receivable as one adjustment and then the allowance for bad debt expense or the allowance for doubtful accounts as a separate item. I've seen that. There's nothing wrong with that. I just personally combine them together because I feel like there's a net receivable, and by dealing with the net receivable, I can more efficiently arrive at the necessary adjustment. And so looking at this particular item, we see that our net receivable was $135 at the end of 2019, and that comes from the combination of the receivable and the allowance. And then we see that in 2020, the balance or the net receivable was $175. So it went from 135 to 175. So now we got to think, if my receivables increase, is that a source of cash or is that a use of cash? And if we think about what's happening, that means that people are not paying me. And so that's actually a use of my cash. And so the increase in the net receivable is actually a decrease in my operating cash flows that are not captured as part of my net income. So that's why you see the adjustment on the cash flows from operations section of the statement of cash flows. You see that as a negative adjustment, a decrease in my operating cash flow. Again, because I have more receivables, that's a decrease to my cash flow. And the second one is inventory. So notice in 2019, I had $200 of inventory. In 2020, I had $130. Well, what have I done? I was able to reduce my inventory. Again, it doesn't change my cost of goods sold, but it does mean that now I don't have as much cash tied up in my inventory. And so my more efficient management of my inventory is actually a source of cash. And so the decrease in the inventory account is an upward adjustment to get to my operating cash flow. So notice that the direction of my current assets, so the change and the adjustment are opposite. So the increase in the net AR was a negative adjustment. The decrease in the inventory account was a positive adjustment. And when we talk about current assets, that's exactly true. Whatever the change, the adjustment is the opposite. So in other words, if I increase a current asset, that's going to be a use of cash. If I decrease a current asset, that's going to be a source of cash. And it just makes sense, right? Any ability to manage those assets, it's going to be uses and sources of cash. And so with the prepaid rent, again, there's an increase in my prepaid rent, so that's going to be a use of cash. Supplies increase, that's also going to be a use of cash. Now the next account down is land. As soon as we get to land, now we're into non-current assets, and those are investing activities. And so we get to stop on the asset side once we get to supplies. All right, now in the chat, I don't know how many people are feeling like chatting today. It's our last lecture, but sorry, I need caffeine. All right, so let's talk about the accounts payable account. So you can see the balances, and so I want you in the chat to give me the adjustment. So I want you to give me the adjustment. Uh-oh. What's going on here? I guess I'm not moving enough? I don't know. All right, help me out. Is it? All right. I am getting responses. I was starting to worry that something happened. Okay, so Jason says increase by 15. See if anybody else. So again, give me the adjustment. I guess I was sitting way too still. I didn't even realize it. I'll be more active. Sorry, in my YouTube channel, it tells me when I'm not moving enough. All right, so we have a $15 decrease, a $15 use, an increase of 15, a decrease. So we're going both directions. That's not a bad thing, by the way, to answer. So clearly, about half of you are wrong. And there's really nothing wrong with that. You're much better off taking a shot and getting it wrong than you are sitting there quietly. And so let's kind of walk through this and let's think about it. So if I have payables of 85 and then I have payables of 70, what's happened? Well, what it means is I've been able to collect more of the outs, or in other words, I've had to not collect. I've had to pay more of my payables. So I've paid down my payables. Now, if I say paid down, does that feel like a source or does that feel like a use? Paid down. Is that a source or a use? Just go ahead in the chat, or I'll just kind of count to 3 and you answer out loud or put it in the chat. So on the count of 3, say source or use. I've paid down my payables. Right? On the count of 3. 1, 2, 3. All right, so Harry says use. Jason says use. And you're right, that is a use of cash. And so that use of cash. Good, 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 good. So the use of cash, of course, then is a downward adjustment. Again, uses are negative adjustments, sources are positive adjustments. And so that's a use of cash, and so that's a negative adjustment. So similarly, with salaries payable, is that going to be a source or a use? And is that adjustment, again, so on the count of three with the salaries payable, just is that going to be a source or a use? On the count of three. 1, 2, 3. Use. Good. Good, good, good. Good. Yep, so it's a use. And given that it's a use, it's going to be a downward adjustment. And then finally, the unearned revenue is also a current liability. And so it is also a use. Dividends payable is a current liability, but that is a financing activity. Just like short-term notes payable is a current liability as well, but that is also a financing activity. So they're not included here. So again, we're just talking about operating current assets and current liabilities that deal with operating activities. And so now we have all of the adjustments that we need to make. Okay, so now given all the adjustments, basically from there you just add everything up. And what we have in total then is a positive $400. So it's a positive $400. Now, US GAAP does not prescribe exactly the way that we format how we describe the $400 increase. The book uses, and so I'm going to be consistent with the book, it uses this term provided by. So cash provided by operating activities. That is the most common terminology that I have seen. And so on the test, you do need to identify through your use of words whether the aggregation or the activity section, whether there's cash that's a positive or a negative cash flow. And the way that you identify that is by saying either provided by, or the other term, if it's a negative cash flow, would be used by. So in this case, we have a positive operating cash flow, so it is cash provided by operating activities. If it had been negative, then we would say cash used by operating activities. So again, provided by operating activities. And so really the question here is, is this expected? Is this what, a positive number, positive $400, is that somewhat expected? And the answer honestly is yes. Typically, if net income is positive, then we would expect operating activities, the cash provided by operating activities, to also be positive. That's fairly common. And we usually anticipate that the operating cash flow is going to be more than net income. Not always, but most of the time. And the reason why we say that is because depreciation expense and amortization expense are typically fairly large items. And so with those add backs, usually with those add backs, you end up with a bigger number. So just be aware of that. And so I think that's it there. All right. So the next section that we need to complete is the investing section. So we're going to continue now. Typically speaking, on your spreadsheet, you're going to be moving north-south. So you start with operating activities, and then investing below that, and then financing below that. So that's how you're going to prepare your statement of cash flows on the test. I'm having to kind of go left to right here, and the reason why is because there's not enough space. So my screen's oriented the opposite way of what I would want. So we're just kind of imagine this investing section being below the operating section. So the next thing we're going to focus on then is cash flows from our investing activities. So when we talk about investing activities, financing is kind of the same way. This is definitely more like the puzzle part of the problem. You're going to start with the beginning balance in whatever account you're focused on. You're going to analyze transactional information. So there's some additional information that will be part of these problems. And so you need to analyze that information. You're going to calculate from that information what the balance ought to be. In other words, if that information captures everything, then the balance should be whatever you calculate. But nearly always that's not going to be the case. And so you compare the inferred balance to the actual balance, and then you can understand any cash-related transactions that are implied from that. So one way we're doing this puzzle is you look at, let's say, land. I was going to start with that as an example. And you say, okay, I have a beginning balance, I have an ending balance. There are certain items that are explicitly disclosed. And so you say, okay, well, given those specific items, the land balance has a beginning balance. Let me account for all of those changes. And from that, that tells me what the balance ought to be, an inferred balance. Now, if there's a difference between that inferred balance and the actual balance, then there must be some activity that's not specifically identified in the problem that explains that difference. For these problems, any unexplained difference, by definition, is a cash flow. All right? And we're going to talk about how that works, but that's part of the way we're testing you in this particular chapter is, can you infer? Can you understand how to interpret the missing information? And again, I want to be clear, this isn't something that you practically have to do in life as an accountant. Totally not what you have to do. However, that thinking is 100% required of an accountant. In other words, an accountant needs to be able to kind of look at information and understand what's missing and understand sort of a piece of the puzzle that, wait a second, this isn't quite adding up. And really, there's no way for us to test you on whether you have that skill set other than the statement of cash flows. And so the reason why I really like this chapter is because it's really pushing that skill set forward a little bit and allowing us to evaluate it. Because, bookkeeping is take the entry amount, throw it in. Take the amount, throw it in. Take the amount, throw it in. That's bookkeeping. You all are pursuing an accounting degree. An accounting degree says, okay, I can do that all day long. I know how to put information in. But now I can look at the information and I can interpret it. I can understand, wait a second, this doesn't add up. This doesn't make sense. What would explain this difference? And so that's what we're trying to develop here. Again, it's one chapter, so it's not the entire class, but probably more so than any other topic that we've done, this really gives you a chance to flex your accounting muscles more than your bookkeeping muscles. And so I really like this chapter for that reason. I used to, when I first was teaching accounting, I think I struggled in communicating the importance of actually doing this. But the more years that I've done this, the more and more I understand how important this skill is and how this is a great opportunity for you all to demonstrate that you have that skill. All right, so that's kind of where we're going to go. That's what we're trying to demonstrate, this intuitive skill that every accountant needs. All right, so there's some additional information. So there's a depreciation expense and amortization expense, and I just specified the items. Then there's some purchases of land and some sales, some equipment, a building sale. And then we had some non-cash transactions down here. And then finally, we had some financing activities. And so all of this information is information we're going to need to complete the rest of the statement of cash flows. All right, so all of these, what I've highlighted here in red, these are our non-current assets, and this is where we want to look to understand our investing activities. So again, all those non-current assets, and we need to understand those account balances, the changes in those account balances, and understand any implications that there may have been for investing-related cash flows. So we're going to start with the land account. And so what I typically do is I go through the additional information and I just look for the word land. And anywhere I see land, I highlight it. And so I say, okay, well, I got this $75 of land by issuing a bond, and I have another land that was sold that had a cost of $85. And so now I've got some information about my land account that I'm going to use to understand what's going on. And so basically now we're starting our cash flow from investing activities, and we're doing land account analysis. And so we start with the beginning balance of $800. Now we were told that they purchased some land with a bond, and that purchase was $75. And we were also told that we sold some land that had an original cost of $85. Now, what you must understand is that whenever we sell a non-current asset, it comes off the books at cost. And so when we're analyzing the land account, the sale, the cost is what's relevant to the land account analysis. However, If there was a sale, that means there must have been a cash flow related to that sale. Now, the $85 cost does not tell us the cash flow. That just tells us the cost of the item that was sold. However, we can use that information in order to arrive or calculate the actual cash flow. And so that's the next step. And so we know there was this land sale, and so we start with the cost and say, well, this was the cost of the land. Then we go to the income statement, and we see that there is a loss on sale of land of $20. And so we have to say, okay, well, if I had a cost of $85 and the loss on the sale was 20, what can we conclude from that? All right? We can conclude then that the cash that I received from that sale must have been $65. Again, the cost $85, the loss on sale of 20 implies that the cash that I received from the sale was $65. I kind of want to stop there because that's kind of the first major step in doing this analysis, is connecting what we see on the balance sheet to information that we are given in the additional information, to information on the income statement, all of that to arrive at a cash flow. So I'm going to stop there in case anybody has questions. Okay? All right, so the next step then is if this is the only information that we have about the land account. If this is all that had happened within the land account, then the balance in our land account would be $790. In other words, if the information that we were given, if this was all that had happened with our land, then the balance in the land account should be $790. However, the actual balance was $845. So in the chat or on your own out loud or quietly to yourself, whatever you feel comfortable doing, what does that imply? What does that tell us? What if the implied balance is $790 but the actual balance is $845? What can we conclude from that? What must have happened? Any ideas? Maybe a longer sentence? There was a use of 55. Give it another minute to see if anybody else wants to chime in. Anybody agree with Harry? Just give me a yes or a no. All right, well, Harry's right. So that means there's this implied purchase. And so the term that we're going to use is cash paid from purchase of land. Yeah, exactly, Harry. That's the unexplained difference. And so again, that's a use of cash. That's a negative cash flow because we're paying for the land. So Harry had it exactly right. And so again, that's what we can conclude from our land account analysis. And so now we're done with our land. We have calculated the amount the cash that we received from when we sold our land. We also have the cash that we paid when we purchased land. Okay. All right, the next one is the equipment. And so there's two places where we find information on the equipment. First, we can see that they received $25 for equipment that it sold. And we can also see that when the equipment was sold, that it had accumulated depreciation of $40. How did we know the $55 matched with the purchase? Again, with these problems, and I say it explicitly on the test, but with these problems, we assume that any unexplained difference is a cash transaction. And the way that I say it is, unless otherwise stated, all transactions are cash transactions. And so we have this unexplained $55 difference, and the only thing that would explain that would be a purchase. And then the second bit of information is that they also purchased some equipment issuing a short-term note. And so this is the information that we're going to use to analyze the equipment account. So again, we start with the beginning balance to analyze our equipment account. The beginning balance is $165. That's just given on the balance sheet. We're told that we sold some equipment that had a cost. Now, if you go back, we're told that they received $25 and that the equipment had accumulated depreciation of $40. Notice that with this information, we're actually not told the cost. I put in a cost of $45. Now the question is, how did I get that cost? Let's do some analysis on that sale and try to figure out where that $45 came from. So we start with the cash that we received. And then we go to the income statement. And we can see that there was a gain on sale. All right, so there's a gain on sale of equipment. So taking that information back to our analysis, it tells us that if I received $25 and there's a gain on sale of $20, it must be the case that the book value of the asset that we sold had a $5 book value. Again, this is thinking about when there's a sale and there's a gain, what does that imply about the book value? We also know that equipment has accumulated depreciation. This is where that $40 of accumulated information becomes important, because we are told that the equipment that was sold had accumulated depreciation of $40. And so given the implied book value, it must be the case that the equipment that we sold had a cost, an original cost, of $45. And so then when we sold that piece of equipment, the change in the equipment account is going to be based on the cost, not on the cash flow. We're given the cash flow of 25. We notice that I've now included that in the investing section of the statement of cash flows. But when we're talking about analyzing our equipment account, that's when the change is based on the cost. I'm going to stop there because usually this is the part where we're starting to get it's a little bit more difficult to understand how to put everything together. So I want to just pause there, let folks catch up for one thing, and also give you an opportunity to ask some questions or seek clarification if you need it. The $65, we had solved that before. So let me go back, Shane, real quick. All right, so in that lower left-hand part, the land sale, notice that we were given that the cost of the land was $85. That's given in the extra information in the problem. From the income statement, we know there was a loss. And so then from those two pieces of information, we know that the cash we received from the sale of land was $65. That's where we got that information, is from this calculation right there. Okay? Alright, so now the other information we were given is that there was a purchase of equipment by issuing a short-term note, so that would obviously increase the equipment account balance. And so if this is all that had happened within the equipment account, we should observe, in other words, there's an implied balance in the equipment account of $155. However, the actual equipment balance was $210. And what that means then, given the actual balance of $210, the only thing that would explain that difference is a purchase. And so that means from the information in the problem, there is an implied cash purchase in the amount of $55. And so we know the cash paid from the purchase of equipment is also $55. It's just kind of random that it's the same number, but it just happens to be the same number. Again, we're putting together a puzzle. Okay? All right, the next account. Building. So it says 49er sold a building that had an original cost of $200 with $125 of accumulated depreciation. And then 49er purchased, and that should say January 1st, 2020. I missed that date. Oh, I missed several dates in here. This is a problem that I've used for several years. I like the problem, it works well. but I'm going to change all this right now. Of course, that means all the other slides are wrong, but so be it. All right. All right. All right. So again, we also have that there was a non-cash transaction where we purchased a building in exchange for common stock. Where did the gain on? Oh, that came from the income statement, Nate. So gains and losses are on the income statement. So we also have this non-cash transaction. We also have the non-cash transaction. So we got to use this information again to understand what's going on within our building account. So again, the beginning balance of the building account was $750. We are told that the cost of the equipment that was sold was $200. Now, given that a building was sold, it's likely the case that there is a cash receipt from that sale. Of course, that cash amount is not the same as the cost, and so now we're going to have to do a little bit of extra analysis to understand the cash flow from the sale. And so that's what we're doing down below. We were given the cost of $200. We were also given the accumulated depreciation that was just given in the extra information. So what that tells us then is the book value of the building that was sold was $75. And so we have a $75 book value. Now, is that the cash flow? Well, the only way we can know that is if there is a gain or a loss. And so let's go over to our income statement. And we can see that there is a gain on sale from the building of $60. All right, so gain on sale. So given the gain on sale and the $75 book value, we know that the cash that they received from the sale of the building must have been $135. So the cash received from the sale of the building, $135. Again, we had to back into the cash amount based on the cost, accumulated depreciation, and the gain that was reported on the income statement. So again, putting together that puzzle. So the other information we were told is that there was a purchase of a building using common stock for $75. So that tells us that, again, that if this is all that had happened in our building account, that the balance in the building account should be $625. The actual account balance is $780, which means there must have been a purchase of $155. So again, that's where this information comes from. You're trying to reconcile the implied balance to the actual balance, and in this case, there's an implied purchase of $155. Again, putting together the puzzle. Okay. The last two accounts are the patent and the trademark. You can see that both of them had a change in their account balances. We also just have to remember that amortization is a direct reduction to patents and trademarks directly to their accounts. There's no separate accumulated amortization account or anything like that. And so we do know that the amortization expense does decrease the patent and trademark. We just have to figure out how much in each account, because both of them are amortized. So then we go again to the extra information that we have, and we have our trademark and our patent, and we have a beginning balance for each account. The beginning balance for the trademark was given as $145. The beginning balance for the patent was given as $45. Now we're told that the trademark amortization expense totaled $20 for 2000. It should be 2020, my bad. But the trademark amortization was $20. Now I'm going to go back. Notice that the total amortization expense was $25. And so if $20 of it was the trademark, we can conclude then that the remaining $5 must have been amortization of the patent. All right? And so again, that information that we use, again back to the $25, it must be the case then the amortization of the trademark was $20 and the amortization of the patent was the remaining $5. Again, putting together the puzzle. From this information, the balance in the trademark account ought to be $125 and the balance in the patent account ought to be $40. If we kind of go back, you can see that the patent balance is $65 and the trademark balance is $200. And so those are not the implied balances. And so again, we have a difference between the implied balance and the actual balance. and the thing that would explain that difference is a purchase. And so there's a purchase of a trademark for 75 and a purchase for a patent of 25. Again, the rhythm of the puzzle is hopefully getting similar. Again, you start with the beginning balance, identify all the things that we know happened, in other words, the things that are disclosed that happened, and that gives us an implied balance. We compare the implied balance to the actual balance, and there from there we can calculate an implied purchase or an implied sale. Okay. So now we're continuing with our statement of cash flows. Again, we had already done the operating activities. Now we're summarizing the investing activities. And you can see that's a negative 140. And again, the term that we're going to use in order to be consistent with the book is cash used by investing activities, because it is a negative cash flow. And by the way, a negative cash flow from investing activities is very common, because what that means is you're buying more non-current assets than you are selling. And generally speaking, companies are investing in their non-current assets over time. Again, I'm just going to kind of pause there, make sure that everybody's following. Okay. Now, financing activities. Very similar rhythm. I'm probably going to move a little more quickly through these, just because the type of calculation and the order of calculation is exactly as we had seen in the investing activities. And so, one of those things that I'm like, okay, I don't want to bog us down too much, especially because I do want to get to the direct method and make sure that we cover that a little bit better. All right, so with financing activities, again, this is just like we had done. You start with the beginning balance, analyze transactions, calculate an inferred balance, compare it to the actual balance, and then understand the implied cash-related transactions for that item. So it's exactly what we had done for our investing activities. So there's no difference there. Now, I will say with the dividend payments, you have to understand the dividend within the context of retained earnings. And if you remember, usually in your principles class, you talked about a statement of retained earnings. And the statement of retained earnings had a beginning retained earnings plus net income minus dividends declared gives you your ending retained earnings. We're going to use that framework in order to calculate the dividend payments that were made during the year. All right, so again, here we're dealing with financing activities. So you stop with your sort of the operating liabilities, and then everything past that, those are financing activities, whether it be debt financing or equity financing. You can see that the dividend payment or the dividend payable is there, the note payable, or bonds, common stock, and we're going to use the retained earnings in the context of our dividends. And so that's why all of those accounts are important to our financing activities. So we're going to start with the short-term notes payable. We're going to save the dividends, even though that's the first one listed. We're going to save the dividends for the retained earnings. We're going to wait for that one at the end. So we're going to start with our short-term notes payable. And again, we have our beginning balance is 145. We're given some information that some equipment was issued, or some equipment was purchased by issuing a note. And so given that, the note payable balance increased by $35 from that issuance. And so the implied balance is $180. The actual balance is $135. And so given that difference, it tells us that there must have been a retirement. Now, retirement is the correct term for debt. So you retire debt. And so when we talk about getting rid of that short-term note payable, or the payment on a short-term note payable, we're going to use the term retired. So retired short-term note payable. You must use the word retired. Again, I'm being a little more picky here, because now we're kind of moving past some basic bookkeeping, and we're really trying to stretch those accounting muscles. And so I want you to use the right terms. And so when we talk about debt, we retire debt, or we issue debt. But in this case, of course, there was the retirement of the short-term note payable. And of course, that's a use of cash, and so that's a negative cash flow. All right, so now we have the bond. We're told that we purchased some land by issuing a bond. We're also told that we retired a $125 bond. And so again, we have our beginning balance of the bond payable of $450. We're told that we purchased some land, and we're told that we retired a bond for $125. And of course, to retire that bond, that is a cash flow. So the retired bonds payable, that's a use of cash for a negative $125. But now with all this information, we can see that the bond payable has an implied balance of $400. The actual balance in the bond payable is $630. So what would explain that difference? And so in the chat, if you're staying with me, what would explain the difference between 630 and 400? And see if you can even use the right term. What explains that difference? Anybody have any ideas? Issued additional bonds, extra debt taken on, so it's a source. See if anybody else wants to chime in before. Both of you are right. So there's a difference of $230, and that is an implied issuance, which is a source of cash. And so the issued bonds payable, a positive cash flow, $230. Good job, good job. All right, so now the next account is our common stock account. And we're told 2 bits of information about our common stock account. There was a $75 purchase of a building, and we issued $185 of common stock for cash. So again, we start with our beginning balance in our common stock account from the balance sheet of $1,350. We're told that we purchased a building by issuing common stock, and we're told that there was a cash issuance of $185. So the nice thing is we're given that cash flow. Issued common stock for cash of $185. That is a source of cash, so that is a positive cash flow. That implies that the balance in our common stock account should be $1,610, but the actual balance is $1,525, and so now there's a negative difference. And so what would explain that $85 difference? And see if you can use the right term. You got to be careful on this one. I'm going to give you a hint. The correct term is not retire. That is not the correct term, and it's also not paid. That's not the right term either. So see if you can come up with the right term for what would explain that $85 difference. Stock buyback, treasury stock of 85, treasury stock purchase. Good, you guys are right on top of it. Yep. So there's a repurchase of common stock for $85. If you had said treasury stock purchase, I would have counted that completely correct. Stock buyback, probably not, Jason. But again, this is the term that we most commonly see used is repurchase. Treasury stock purchase also would be acceptable, but repurchase is the more common. Repurchase of common stock is more commonly used. But all that to say, of course, that's a use of cash. That's a negative cash flow. And so we've kind of worked our way down. So now we're all the way down to that retained earnings account. And we know with the retained earnings account, that's where we're dealing with dividends. And so when we're dealing or trying to figure out what's going on with dividends, not only do we have the retained earnings account, but of course in this case we have a dividends payable account, and we also know that net income plays an important role in understanding what happens with retained earnings. And so the whole idea here is we have the beginning retained earnings plus net income minus dividends declared gives us ending retained earnings. I'm after the dividend payment. So when we talk about dividends being declared, that is useful information in understanding how much dividends were paid. Now, of course, the amount declared is not necessarily the amount that was paid, especially given that there is a dividends payable account balance. And so we'll use that information, though, in order to get to the actual dividend payment in 2020. Again, these are all the pieces of information that we have to put together. Okay, so we have our beginning retained earnings. We know that we had net income of $325, which means if there had been no dividends declared whatsoever, 0 dividends declared, then the retained earnings account balance should be $680. However, the actual retained earnings account balance is $635, which means that there was declared dividends of $45. If there were no dividends payable, then the declared dividends would have all been paid. We get that, that's easy. So, but in this case, there is a dividends payable account. So we have to go another step. To get to the dividends paid, we have to use the dividends payable account along with the implied declared dividends in order to arrive at our answer. So our beginning dividends payable was 20. If the company had only declared dividends and had not made any dividends payments whatsoever, then the payable balance should be $65, because we know that when you declare a dividend, that gets added on to your dividend payable account. And so if nothing had been paid, the balance in the dividends payable account should be $65. The actual dividends payable account balance is 10, which means there must have been dividends paid of $55. Again, this is just remembering how dividends work. And so the dividends paid, again, that's a use of cash for $55. So all of that information together. Again, we started with the operating section. We had already completed the investing section. Nice. So McSwift is my son. Thanks, Grant. Well done. He said he was going to do it, and he actually did. Oh, what a goofball. I love it. So he's 14, newly minted 14-year-old. So pretty cool kid if he'll log into his dad's live lecture and make a comment in the chat. Love it, love it, love it. All right, so so your cash flows from financing. Nice. Now don't spam me, okay? So the cash flows from financing activity now is where we're at. All right, we're good, buddy. All right, so we had done the investing activities. Now we're in the middle of calculating our financing activities, and you can see here that the total of that amount is $5. So if we kind of add up everything in that final column, we get $5. And so, Real, help me out in the chat. Is that going to be cash provided by? Yeah. Is that cash provided by or cash used by? Shane, so the dividends paid amount, let's go back to the previous slide. So look at the lower left-hand corner. So we use the retained earnings account in order to get to the declared dividends. And then we use the declared dividends along with the dividends payable account balance, which gets us to our implied dividend payment. So that's where that dividend paid came from. So Harry, this is actually a cash provided by financing activities. So positive cash flows is provided by, negative cash flows is cash used by. Okay? So cash provided by financing activities. And I would say as far as an expectation, financing is one of those that kind of bounces back and forth. So I can't say that I expect positive or expect negative. I think as a user of this information, if I were looking at it, I would say, what do I expect to see? Nothing too big one way or the other. So if I saw a huge positive financing cash flow, I would kind of wonder what that was. It's not bad. I would just wonder. And if I saw a huge negative cash flow from the financing activities, I would kind of have the same question. Like, okay, what happened here? There could be a great explanation, but it would just be something to kind of say, what's going on here? If it was a large cash flow. So again, with all of these, you start with the operating section, then you do the investing section, then you finish with the financing section. And with each one, I would say with the first one, you expect a positive cash flow. With the second one, you expect a negative cash flow. And with the third one, I can't say you expect positive or negative. You just don't expect extremely large. That's just not typical. Does that make sense? All right. So then the bottom section, the remainder of the statement of cash flows. So the after you do each section, then you list the beginning cash balance. Then you calculate the net change in cash. So you basically sum up the three activities together. So 400 minus 140 plus 5 gets us $265 positive. So that means in total our cash increased $265. And so that would give us our ending cash balance. Now, if you're wondering if you're correct, by looking at the ending cash balance, it's an indication that you might be correct if it matches the balance sheet. So in this case, you can see that our ending cash balance is $780. And if I kind of go all the way back to the balance sheet, if I can find it, the ending cash balance, if you look over on the comparative balance sheet, the 2020 cash balance is $780, right? And so those two do match up. Now, I will say, just because they match up, it doesn't mean that you for sure have everything correct. If they don't match up, you for sure don't. So in other words, something is wrong if it's not equal. But for me, if I get to the end and it equals, I probably am going to leave it alone and assume that I've done everything correct. There's the potential that there could be a minor mistake still, though. And there's one additional disclosure that I'm going to require for this statement of cash flows, even on the test, and that is significant non-cash activities. And so if there's a non-cash activity listed in the additional information, then you do need to disclose that on the statement of cash flows for this class. And so the significant non-cash activities that were listed in our additional information are also listed here. I will say in practice, companies do have some flexibility on where to disclose this information. They can disclose it at the bottom of the statement of cash flows, or they can disclose it in a note related to the statement of cash flows. Most of the time, the information is actually in a note. It's not on the actual statement itself. But for this class, when you do the test, you do need to separately do so. Oh, the chat window is blocking it. All right, give me a second. Would you look at that? Yeah, usually it's not quite that far over. All right, I'm trying to fix it. Give me a second, guys. All right. Pop back over. Thank you for pointing that out. I had no idea that that was being blocked. I can't really see that on mine. So hopefully that got it. Sorry about that. All right. So that is a statement of cash flows using the indirect method. So that is the indirect method with the statement of cash flows. All right, so now the direct method. Under the direct method, the firm classifies operating cash flows by each activity. So rather than having one aggregation in the operating section, it's item by item. The investing and financing sections are the same. Just so you know, on the test, what you're going to have to do is create the entire statement of cash flows using the indirect method, and then create the operating section only using the direct method. So you're going to have to be responsible for both. So definitely pay attention to this. You're going to need to be able to do both for the test. All right, so same information, nothing there has changed. Now, what I do, I think this is just a good approach, generally speaking, is to get to each individual activity. I find an item on the income statement and think about the cash flow related to that specific item. And so as an example, when you talk about net sales, well, that's that's a transaction with my customers. And so the related cash flow would be receipts from my customers. So once I have net sales identified as the income statement that I'm going to focus on, I think about the cash flow related to that item, in this case, receipts from customers. Then I have to think about all the other accounts that might relate to that specific cash flow. And in this case, bad debt expense is one. So in other words, I can make a sale, but if I don't collect on it, that's going to affect the actual cash flow. I also need to think about my receivables. In other words, am I billing my customers or are they paying me? And then I also need to think about what's going on with my allowance for bad debt expense, of course, because that relates to write-offs and lack of collection. And then finally, we have unearned revenue, because that's, of course, also related to cash receipts from customers. And so you can see right away, we've got a lot of different accounts that we have to think about with this one particular cash flow. All right, so let's talk about cash receipts from customers. So again, we start with net sales. Then we think about beginning accounts receivable. So again, we're going from the income statement item to the cash flow related to that specific item. So let's think about beginning accounts receivable. What does that mean? Well, that is revenue or sales that we recorded in 2019, but were collected in 2020. And so with this adjustment, this beginning AR, should this be a positive? In other words, is this an additional source of cash? Or is this a negative? Is this a use of cash? So in the chat, is this a source or is this a use? So positive or negative when we're talking about this adjustment? Harry says source. Source. Yeah, it's a positive adjustment. So that's cash in that wasn't included in net sales. So that's an additional source. And then ending AR is a use. It's kind of a weird way to use the word use, but it is an adjustment. It's a negative adjustment because that's a sale that would have been recorded, but cash that we have not yet collected. And so the ending receivable is a negative 190. All right, so the beginning AR is a positive adjustment. The ending AR is a negative adjustment. Now, write-offs. So this is where we're dealing with bad debt expense. And so the whole idea here is I have to reconcile inside my net sales along with those receivables that I have completely written off. In other words, because there's something that could explain a decrease or a change in my receivables that doesn't deal with cash, and that's if I wrote something off. And so I need to understand, were there any write-offs? And so how do I get to write-offs? So you start with your beginning allowance for doubtful accounts or allowance for bad debt expense. You add the bad debt expense to that beginning balance, and then you subtract any ending allowance for doubtful accounts. So this is the equation that allows you to calculate your write-off. Beginning allowance plus bad debt expense minus the ending allowance. That gives you the write-off. And in this case, the write-off was $15. And so again, that write-off is negative because it's not really affecting net sales as much as it's affecting how we account for our receivables. And so when we do a write-off, that's a decrease to our receivable. And again, think about that beginning balance. We assumed that we had collected all $145 of that. That's what we made an assumption on. But of course, in this case, we can see that, oh, actually, we wrote off 15 of that $145, which is why we need to make a negative adjustment. Typically for students, that write-off is probably one piece where they struggle a little bit with understanding why we have a negative adjustment for the write-off. But hopefully that explanation helps you. And if you didn't get it initially, maybe watching it back will also help you. So now we have the beginning unearned revenue, and I jump right to the negative. And the reason why I jump to the negative, I just kind of give you the answer there, is because, again, beginning unearned revenue, what that is cash that we were paid in 2019 for sales that we will make in 2020. And so what that's saying is there's a net sale number here that actually doesn't include a cash flow because the cash flow happened in the previous year. And again, we want the cash flow for 2020. And so that's why that's a negative adjustment. And similarly, or for similar reasons, the ending unearned revenue is a positive adjustment. And again, the thinking there is that it's cash that I received in 2020 for a sale that I will record in 2021. And so that's why it's a positive adjustment, because there's still a cash flow. It's a receipt that I got from my customer that was not included in my net sale number. And so when I add all those up, my total cash receipts was $1,450. Okay? All right. Next item, cost of goods sold. So cost of goods sold, those deal with payments that I make to people that supply me with my inventory. And also I'm going to include in this supplies expense, because those are also a form of suppliers. So you could do these two separately. I'm just going to put them together to be a little more efficient. But we're going to kind of put those. So these are all payments that I'm making to people who supply me with inventory or other items. And so we're just going to use this term, payments to suppliers. And so we're going to combine both these items together. So those are the income statement items. And we also have, of course, balance sheet items. So the inventory account, the supplies account, and also accounts payable. All right. So we're going to kind of use all of this information to arrive at payments that I've made to my suppliers. Now remember, the first calculation was a receipt. Now I'm calculating a payment. So it's a little bit different. All right, so with our cash payments to supplier related to the inventory and cash payments to suppliers related to my supplies. So we're going to start with cost of goods sold on the top. We have our beginning and ending inventory. So when we're talking about payments, let's talk about the adjustments from the beginning inventory first. So with the beginning inventory balance, again, this is a payment, right? Should this be a positive adjustment to the payment or a negative adjustment to the payment? I'm not going to use the term source or use, because whenever we talk about payments, I think students tend to get flipped around. So I'm just going to talk about whether it's a positive or a negative adjustment. So Jason says it's a negative adjustment for beginning inventory. Beginning inventory negative. So Harry and Jason both agree that there's a negative adjustment. And that is true. So the beginning inventory is a negative adjustment. The ending inventory is a positive adjustment. Let me kind of walk you through why very quickly. So with beginning inventory, that's inventory that I purchased last period, in 2019. And it's inventory that I'm likely going to sell this period. So in other words, my cost of goods sold acts as if I bought that inventory in the current year, but I did not. Some of the inventory I bought in the previous year. And so that's why the beginning inventory is a negative adjustment. At the same time, the ending inventory is a positive adjustment. And the reason that the ending inventory is a positive adjustment is because that's inventory that I bought in the current period, but I have not yet sold. So it's not included in cost of goods sold, but it's a purchase that I made. And so that's why it's a positive adjustment. And so how about accounts payable, beginning and ending accounts payable? Because the fact is, I can buy inventory on account. And so we need to make sure we adjust for any inventory that may have been purchased on account, or other purchases that were made on account, of course, as well. We're just going to use them here. Beginning accounts payable is a source. So I think you're saying the beginning is a positive adjustment. And then the ending accounts payable, same idea. So with the beginning accounts payable, of course, that's basically a payment that I made in the current period for an expense I incurred in the prior period. Whereas ending accounts payable, those are expenses that I incurred in the current period from payments that I'll be making in the next period. And so again, the expense related to that account payable for the beginning accounts payable would have been part of cost of goods sold in 2019. But I made the payment in 2020, so that's why it's a positive adjustment. For the ending accounts payable, that expense would have been included in cost of goods sold, but it's not a payment I'm going to make until 2021, which is why it's a negative adjustment. And so the total payments to suppliers, if I add all that up, is $665. Again, suppliers related to my inventory. Now, as far as the treatment of accounts payable, I always include it with the payments for inventory. However, we're all aware that there may be accounts payable related to other items. In this particular case, we're always going to put accounts payable in with the cost of goods sold and inventory account. We're going to always relate them together. So for suppliers, we start with that supplies expense, which is from the income statement. And then we have beginning supplies and ending supplies. Again, these are payments. And so the adjustment for the beginning and ending supplies, it's a negative for the beginning and a positive adjustment for the ending. Again, let me kind of walk you through. Supplies expense assumes that those are all supplies that I purchased in the current period. However, some supplies I actually purchased in the prior period. And so the beginning supplies, those are supplies that I bought in 2019, but I used in 2020. That's why it's a negative adjustment. The ending supplies, those are supplies that I purchased in 2020, but I will not expense until 2021, which is why it's a positive adjustment. Again, so that gets me to the total payments for supplies to suppliers related to our supplies of $45. And I add those up, and so my total cash payments to suppliers is $710. Again, because these are payments, it's a negative cash flow from operations. All right, so receipts are a source, payments are a use of cash. All right, next item, salaries expense. And just to be efficient, we also have rent expense. So both of those items are on the income statement. And the related items are prepaid rent and salaries payable on the balance sheet. So whenever you're talking about cash flow, you go from the income statement through the balance sheet to the cash flow. Now, both of these items, of course, have an accrual related to them. So that's why we have to go through the balance sheet in order to get to the cash flow. So one thing that I've demonstrated in the first two, but I didn't want to be explicit until now, because now it's very obvious what's going on. But whenever you want the cash flow, again, just to re-highlight, you start with the income statement item, you flow through the balance sheet, and then you get to the cash flow. But again, you have to identify the balance sheet item that relates to each specific income statement item. And so with our payments for rent, cash payments to employees, and both of those, we start with the expense. With the rent, we start with the rent expense. With payments to employees, we start with the salary expense. So with both of those, of course, we have the accrual. With the cash payments for rent, just on your own or in the chat, you may not be able to quite get to it in the chat. I'd rather you make sure you calculate it on your own. Help me out on what to do with the beginning prepaid rent and the ending prepaid rent. So you start with your rent expense, and then you have two adjustments. And with the salaries expense, you also have two adjustments. And going back, sorry, I went the wrong way there. You can see the beginning and ending balances for both items, the prepaid rent and the salaries payable. And so the beginning prepaid rent and the ending prepaid rent, along with the beginning salaries and ending salaries. And so let's talk about those adjustments. So with the rent, the prepaid rent, the beginning prepaid rent, that's a cash payment that I made in 2019 for rent expense that I'm going to report in 2020. And similarly, my ending prepaid rent is rent that I paid in 2020, but where the rent expense will be incurred in 2021. 100% right, Harry. Good job. And so that's why we have a negative adjustment for my beginning prepaid rent and a positive adjustment for my ending prepaid rent. And then cash payments to employees. Again, here we have the beginning salaries payable. What does that mean? Well, that means salaries expense that I incurred in 2019 but paid in 2020. So that's why it's a positive adjustment. And then with the ending salaries payable, that's salaries expense that I incurred in 2020 but will pay in 2021, which is why it's a negative adjustment. And so the rent payments, there's 85, and the salary payments is 70. So cash payments to employees, cash payments for rent, both of them, of course, because they're payments, are uses of cash, 85 and 70. The final two items, interest expense and income tax expense. Notice that with those items, there is no related item on the balance sheet. Since there is no accrual related to those two specific items, it means that the expense is also the cash payment, right? So in a situation where you have an expense, but you do not have a related balance sheet item, it means that the expense is the payment. And so that becomes a lot easier because the payment for interest and the payment for taxes we can take directly off the income statement because there is no accrual. And therefore the payments are $40 and $145 each. And when we add them up, we should get the exact same number that we got using the indirect method, which is $400. And so just to kind of verify the two methods side by side, with the indirect method, you can see we start with net income, we make adjustments in order to get to the cash flow. With the direct method, we just go item by item. Again, looking at the income statement, finding the related balance sheet items in order to get to the cash flow for every single item. But in both cases, we'll get the exact same total cash flow. And I believe that's it. Yep. All right, well, that is the lecture, if you can believe it. So like I said, I thought it would be about an hour and a half, and it was. So with the statement of cash flows, again, please do that practice test problem. Also, there's I think you can do it, on hand, by hand, and all that kind of stuff as well. But having that extra test question is going to help. Just practice using the spreadsheet tool that's required for the Lockdown browser. It operates very similar to an Excel spreadsheet, so it's not that different. But all that to say, this is the last live lecture. What I'm going to do, what I already did, is I posted the sort of a comprehensive, so not comprehensive, the Chapter 22 problems, where I walk you through how to do them. I already posted that video. It is part of the playlist for the summer 2020 lectures. Excuse me, live lectures. Obviously, this one will also be posted there as soon as it uploads. There will also be one more lecture that will not be live, but I will post a recording of what was a live lecture last spring, and that's a comprehensive review. So Jason, when you asked, is there going to be anything reviewed for the comprehensive final, the answer is yes. And so what I'm doing with that is it's a fairly lengthy lecture. I think it's 2 parts. But what I'm doing there is I'm going to post the video that I used in the spring in order to give you extra practice on all the different concepts. Again, it's not going to cover everything, but it's definitely going to cover the highlights. And so I'll post that on the playlist as well. So the summer 2020 playlist will be your one-stop shop. And obviously you can go back and look at all the old lectures for any information as you prepare for the comprehensive final as well. But yeah, I think that's everything. Any other questions? Okay, everyone. Well, thank you so much for tuning in. You should have received a notification to do the course evaluation. Obviously, it's a little bit different with it being online, because I can't in person remind you, but those course evaluations are obviously useful for feedback, and also it's used to evaluate me as a teacher, and so any feedback that you provide is very welcome. Other than that, and that's due, I think, Monday at midnight. So August 3rd, I think, is the due date on that. So take the time to do that. Again, I'm going to post everything. Everything should be up and running. Hopefully everybody. You're welcome, Aiden. Thank you for that. And hopefully you have everything you need. I did open some appointments up for Friday, so if you want to go over your test 4, there is appointment slots that I just opened up today, and you should be able to book those. Thank you, Ryan. Appreciate it. Other than that, guys, thank you so much. It's a little bit different because I'm not seeing your faces or anything, but hopefully for an online environment, this worked out okay for you. Yes, Nirmal Kumar, please let me know on the homework. Just a quick email is all you got to do. If you haven't emailed me yet, please email me, let me know that you want the homework to count towards your grade. I honestly, I can kind of tell who wants it to count and who can't by this point in the semester, but being specific would be helpful. That way I have documentation that you wanted it to count towards your grade. But thank you, that's a good question. All right, everybody. I guess it's kind of bye-bye, and maybe I'll see you at some point on campus. Anyway, it's a little bit different, a little anticlimactic. But anyway, thank you so much. I hope you enjoyed it. I hope you learned a lot. And of course, I hope everything goes well on this final test and on the final exam. I'm always available via email if you have any questions. All right, everybody. Take care.